Here's why your credit score may now be higher. Gabriela Cruz Martinez, personal finance writer. Many Americans may get a higher credit score this month after the removal of 70% of medical debt from credit reporters nationwide. As of July, the nation's largest credit reporting agencies, Equifax, Experian, and TransUnion, stopped including paid medical collection debt on credit reports. They also are extending the period before unpaid medical collection debt appears on a consumer's credit report from 6 months to 1 year. And starting next year, medical collection debt under $500 will no longer appear on credit reports. The changes come after 2 years of the ongoing COVID-19 pandemic and industry research that showed the prevalence of medical debt plaguing consumers' credit reports. The move, first announced in March, could also boost some folks' credit scores by 100 points and help them get better term on credit cards, loans, and insurance. It reflects the fact that medical debt is different from the other debt. Bankrate senior industry analyst Ted Rosman told Yahoo Money. It's usually not something that you willingly signed up for, and it's not the same as a monthly mortgage or credit card bill or car loan. The move to eliminate medical debts from consumers' credit reported follows an analysis from the Consumer Financial Protection Bureau that called the nature of the medical billing system in the US complicated and burdensome. The consumers watchdog said the lack of pricing transparency in the system left families at an increased risk of reduced access to credit, falling into bankruptcy and avoidance of medical care as they unsuccessfully tried to sort out bills. The problem was widespread. As of June, more than 43 million Americans owned an estimated $88 billion in medical debt, but that number could be significantly higher since not all medical debts in collections are reported to the Credit Bureau, the CFPB found. Was it even your responsibility? Maybe it was a mix up with insurance, said Rosman, who noted that the credit reporting agencies now have better ways of calculating payment patterns and creditworthiness. There's new stuff starting to come on credit reporters like buy now, pay later and streaming service and cell phone plans in some instances. He said, and the feeling is that those may actually be more representative. Credit scores could increasing by more than 100 points for some. For decades, inaccurate medical bills have too often hurt the most vulnerable and uninsured. Black and Hispanic Americans were more likely than other racial and ethnic groups to have past due medical payments. Approximately 28% of black and 22% Hispanic individuals were behind the medical debts, followed by 70% white and 10% Asians according to the CFPB. The Kaiser Family Foundation revealed that medical debt cut across age groups with young adults and low-income individuals including veterans and older adults most heavily affected by debt. Approximately 3 billion Americans owe over $10,000 in medical debt and 16 million owe at least $1,000. As the credit reporting agencies remove paid medical debt in collections, which until recently remained on credit reports for as long as 7 years, it could lift person credit score by more than 100 points in some cases, according to Rosman. That 100 points increase won't apply as much if you have bunch of other delinquencies or if you have ton of debt, Rosman said, but if medical debt was an isolated instance that was dragging down your score, this removal could be huge. Housing expert homebuyers are hitting the brackets. Sellers won in the driver's seat fielding bidding wars are reducing their asking price while more homebuyers are backing out of deals. The housing market has absolutely shifted and buyers have been hitting the brackets in June. Jeff Tucker, an economist at Zillow, told Yahoo Finance live video above, it suggests buyers are finally including contingencies in the offers they made this spring, which gives them that possibility of opting out. In June, approximately 14.9% or 16,000 home purchases under contract were cancelled according to a recent Redfin report, while 7% of homes for sale had a price drop, a high for records dating back to 2015. According to separate Redfin report, the culprit mortgage rates that are 2 percentage points higher than the start of the year, with major up, down and down movements in the last 2 months. The 30-year fixed mortgage rate dropped to 5.30% last week from 5.70% the week period. Rate fluctuations mean that unless home buyers locked in rates, those who once qualified might become ineligible as rates increase. Its affordability, higher mortgage rates and higher home price means that the typical mortgage payment is over half, about 60%. Tucker said a lot buyers cannot afford that or heard a bad news from their mortgage lender that where mortgage rates are today, you can't afford this house. Inflation and talks of recession also may cooling homebuyer demand. The areas that show the biggest run up in housing price due to the pandemic migration patterns may experience the largest price drops, Tucker said. This is necessary cooling down and rebalancing after we have just had the most unbalanced, overheated housing market on record. Tucker said buyers are pulling back, inventory is beginning to climb, and the last domino to fall is to push home price growth back down. So we should expect it to kind of level off and actually see modest home price declines in certain parts of the country. Runda is a personal finance senior reporter for Yahoo Money and attorney with experience in law, insurance, education and government. Follow on her Twitter. শেষ দেখেন তো কয় মিনিট হয়েছে ভাইয়া